Welcome back to Inner Circle Precision, and in this video we are going to talk about liquidity, which is the first topic in this particular video series. So what I'm going to teach you is basically how to trade whenever there is liquidity that has been grabbed or that has been swept. But before we talk much about that, I need to define what liquidity is. So basically we know that within this market there is an algorithm which is programmed to fulfill the wants of the market makers. So the wants of the market makers is to basically make money out of the markets, and they only can do so if there is enough sufficient contracts that can fill their orders. So liquidity is basically a high that has been issued, like in this particular case, when we actually had this view, it was actually like this. When we had this view, our anticipation was actually to see the market to drop, but that is not what the algorithm needs to do. The first thing and the foremost, we need to know what moves price. So price moves to either two things, it's either to the liquidity pool or basically to an imbalance. So whenever we see something like this, it's basically a sign that there is liquidity above this particular region. Why? Due to the fact that a lot of traders look to put their stops above any high or any peak. So in this particular instance, we anticipate to only trade sales whenever we say liquidity has been taken. When liquidity has been taken, it's basically trading from the highest highs that is actually broken the previous high in context of the market. So in this particular instance, we can now see that we had this high and the market actually broke right above that high. When something like this happens in the short-term period, we actually now anticipate to see the market move in the particular perceived direction. So in this case, this is basically liquidity. When we say liquidity is basically a high that has been issued. So to use this particular liquidity, you need to understand a few parameters so that you can utilize what the market intends to do. In this particular case, the market actually went to the downside like this, and we had this low. From that low, we actually see that, or from the definition that I've provided you, a low that has been broken or a low that has been issued is a point where we say there is possible liquidity below that, because there are retail traders who would have bought from that particular low. So we can see that there was a tip right below that low, and after that tip, the market started to go to the upside. What we want to do is to actually act when the market starts to go to the upside, and we now incorporate another factor, which is basically break of structure. So when we say there has been liquidity sweep, we need to see a break of structure, and after that break of structure, we need to see a PDRA in form of a fair value gap within the flow that has broken structure. So the flow that breaks structure is what we would call market structure shift. So in this particular instance, we have actually built a system where we are saying first we need to see a low being broken, meaning that liquidity has been swept. And after that, we need to see market structure shift going right above the recent high or the recent low, depending on the market context, and then a fair value gap being issued. So in this case, we can see that a fair value gap was issued at this particular point, where we actually see this being the high and this being the low, right? And we actually try to find the 50% concentrate point of the fair value gap, which was at this particular point, and the market actually went to that particular point and it went to the upside, basically like that. So liquidity grab, market structure shift, fair value gap, and you are done. So in this particular instance, having another example, we can see there was this particular structure where we had higher highs, like in this particular case. So higher highs actually signify a much more stronger liquidity pool. Why? Because there will be a lot of traders who will be trapped within this particular process. Why? Because whenever the market comes to resistances, a lot of retail traders would want to sell. And when it comes to a point of support, a lot of traders would also want to buy. So in this case, we can see there was these equal highs. And at first, they were actually like this when people were actually shorting this market. Later to see something like this being issued. And when it was issued, we can see that the market actually gave this double peak. That double peak as well actually was taken, like you can see at this particular point, meaning that liquidity was taken at this particular point, and we had the break of structure. So to label all what I've just mentioned, would say we had liquidity sweep. Then from that liquidity sweep, we had a break of structure, which actually led to our market structure shift. And then after that break of structure, we had the fair value gap, which is this particular point. So someone would ask, what time frame am I using? This particular system is actually fractal. You can use it on M15, H1, daily time frame, H4 time frame, depending on the type of trader you are. And 50% of that particular fair value gap was actually at this particular point. And then you can see the market actually shifted for such a long period of time going to the downside. So basically we are saying you need to actually trade only if there is a liquidity sweep. Then after liquidity sweep, you actually need to wait for market structure shift. And after market structure shift, we wait for a fair value gap. And from that fair value gap, that is where we want to take action from. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe. And please join our free Telegram channel. I'll leave the link in the description box below.